Most franchise buyers start with the wrong question, and that one decision quietly determines everything that follows. They ask, what franchise should I buy? And that question sounds logical, it feels productive, it feels like progress, but it's the wrong starting point. And if you start there, you're already limiting what you can build because that question locks you into consumer thinking instead of investor thinking. I'm George Knauf, franchise investment strategist, and after more than 30 years in franchising, I can tell you this is one of the most consistent patterns I've seen. Here's how it usually plays out. Someone decides they want to get into franchising. They start researching brands, looking at brand recognition, reviews for stores and locations, perceived simplicity, startup costs, and whether it, quote, fits them. Oftentimes, what that means is they're raving fans of the product or service. And eventually, they narrow it down to a few options that feel right. Then they move forward, they buy a location, they get open, and for a while it works. They generate revenue, they build something, maybe even add a second or third location. And on the surface, it looks like success. But then something happens. They stall, they plateau, they hit a ceiling they didn't see coming and can't quite figure out why. The reason is simple. They chose a brand before they chose a strategy. They made a decision based on what do I want to own instead of what am I trying to build. And those are completely different paths because not all franchise systems are built for the same outcome. Some are designed for strong owner operators, single unit success, stable and predictable income. Some can stretch into small multi-unit groups or limited expansion. But very few are designed to support scalable franchise portfolios that create enterprise value and attract private equity. And if you don't understand that up front, you can spend years building something that works, but that you can't scale. Let me give you a real pattern I've seen over and over. Someone chooses a franchise because it feels simple. It feels manageable. It feels like something they can control. They open their first location and it works. They open a second, still works. Then they go for a third, maybe a fourth. And that's where things start to change. Because now the business requires leadership layers and systems and delegation, consistency across all the locations. And the model they chose was never designed for that level of scale. So they get stuck. Not because they're not capable, but because the foundation doesn't support what they're trying to build. And by the time they realize it, they're already committed. So here's what matters. The first question in franchising is not what franchise would I buy? It's what am I trying to build? That question changes everything. Now you're evaluating scalability, leadership structure, expansion strategy, operational complexity, capital deployment, and exit potential. Instead of brand and comfort and familiarity and short-term income. And this is where the gap forms. Most people stay in buyer mode. Some become operators. But the ones who build real enterprise value think like portfolio architects. This is where I introduce what I call enterprise franchise architecture. Before you ever select a brand, you should be designing the structure of what you want to build. And that includes platform selection, or what type of business model supports your long-term scalability. Is it system-driven, or is it process-oriented, or is it repeatable across markets? Or does it depend on heavy owner involvement, constant oversight, and reactive decision-making? Number two, market strategy. Are you building density in one market or regional expansion or a multi-market footprint? because each path creates a different type of business. Number 3, leadership infrastructure. Who runs the business when you're not there? If the answer is, I do, you don't have a scalable model, you have dependency. You have a job. Number 4, operational systems. Can the business operate consistently across locations without your daily involvement or constant problem solving or putting out fires every day? Because inconsistency kills scalability. Number 5, capital strategy. How will growth be funded? And how does that affect speed and risk and long-term value? Number 6, exit design. What does this look like to a buyer 5 to 10 years from now? Is it a platform? Is it an add-on to a platform? Or is it just not investable? If you don't define this up front, you're guessing, and guessing doesn't create enterprise value. Now let's take a look at this through private equity's lens. If you took your business and put it in front of a private equity group, here's what they're going to ask you. Can this run without the owner? Can this scale across multiple markets? Is there a leadership team in place? Are the systems consistent and repeatable? And if the answer to any of those is no, they're not going to be interested because it's not a good business. For them anyway. May be great for you, but they're buying different businesses for different reasons. It's not a scalable platform. Private equity doesn't buy effort. They buy structure and predictability, leadership and scalability. And those things are determined long before you ever open your first unit. So what should you do differently? Before you ever look at a franchise brand, define your outcome. Are you building a lifestyle business, a multi-unit income stream, or a scalable portfolio designed for enterprise value and private equity exits? Because each of those paths requires a different model, a different system, and different decisions. Then, once that's clear, you apply what I call the franchise investment filter to evaluate opportunities based on scalability, leadership transferability, economic leverage, system maturity, and exit alignment. Strategy first, selection second. What's happening right now in franchising is a separation between operators and portfolio builders. Operators will continue to buy units and grow incrementally and stay involved daily. Portfolio builders will design systems, build infrastructure, scale across markets, and position for a private equity exit. And over time, that gap is going to get very wide because private equity isn't looking for operators, they're looking for platforms. And platforms are not accidental, they're designed. So if you're looking at franchising today, don't start with the brand. Start with the architecture, because the first question you ask determines what you end up building. And most people don't realize that until it's too late. I'm George Knauf, franchise investment strategist. I help people build franchise portfolios that create enterprise value and private equity exits.